Thank you very much, David, and let me extend my welcome to everyone to the Essential Treasurer. Clearly, financial risk management is probably the number one core competency for any corporate treasurer, and the risk framework of which that sort of core competency is put together is obviously via the Treasury policy. What I want to talk today is going back to some of the hedging side of this, so really focusing on the hedge policy. One of the things I will do before I start is I will give I was very lucky to attend the FTA's Treasury policy course a few months back, and I was definitely give it a plug. I thought it was a very good course. So what I want to try and do is pick up some of those key themes that I thought was really important from that course, and maybe expand on those. But I also want to sort of build, sort of show some of the way that we at CBA try and sort of expand that out to make that a lot more realistic and much more relevant to what you as treasurers are looking for as part of your hedging, so we can help you pick the appropriate hedge strategy and maybe show you some of the innovative IP that we're coming up with at CBA. What I want to start with is obviously to have a successful risk management policy, we have to go back to basics and really answer the question, why are we hedging? And I think this is maybe an under-asked question from many of our corporates. So the way I think about it is we're really trying to hedge for three reasons. The most fundamental reason is we're hedging to make sure our business doesn't go bust effectively. So we're really, and another way of saying that is to ensure compliance with those key covenants that to the extent we have borrowings to the banks, allow us to maintain ownership of that business. Typically that is very extreme hedging. There's not many corporates out there that I've worked with who have such a big exposure unhedged, and maybe that's why we're still working with them. So the second sort of main reason for hedging then would be, I think, and this is where I think we really start to get a lot of our corporates on board. It's to protect those ratings or other metrics, whether they be debt metrics. And I think the guys from PwC in the previous thing were talking about the interest cover metrics and so on and so forth. And what I've got here is the top chart here is to the extent that we're looking at the interest coverage ratio, the EBITDA to interest cost there, using the blue line, which is the market implied forward rate curve. The interest coverage ratio would be the red bars there. Now, if we sort of apply here a very broad sort of rating agency type criteria of 2.5 times to maintain a single A rating, you can see there that this company looks like it's going to knock the lights out in terms of going through that metric. So there's no real problem. But of course, what happens if that forward rate curve doesn't eventuate and rates go up quicker than was anticipated? Then what we actually see, and we can sort of stress those curves using the green line there, and to the extent that happens, then the yellow bars eventuate, and clearly there's some big gaps. Does this work? Yep. There's some big gaps there. So potentially this would form the framework of maintaining a hedge policy to actually make sure that we can lock in enough of that interest rate curve to actually maintain compliance with those ratings at all times, and therefore have access to potentially cheaper debt and also more debt given that the rating is maintained. The last reason, I think, which is probably the most common reason we see why people hedge, is just to protect some shareholder value. Again, going on the lower chart there, I'll go this way this time. On the lower chart there, we've got the relative red bars to the extent that the forward rate curve does eventuate, or the yellow bars to it doesn't. And what I've done is in green here, done the cumulative difference. And what you can see there is you're talking over a period of a number of years, basically protecting up to $60 million of shareholder value. So I think, the reasons why you're hedging is clearly going to dictate how you actually go about hedging in terms of not just product, but in terms of all the other things that I'll talk about. When we talk about hedging, I like to think of hedging in the three ways on the screen here. So the most common way we see hedging is this systematic hedging, and in my view, this is the most important way of hedging. It really is, as soon as an exposure hits your balance sheet, you do something about it. You don't just leave it sort of flapping out there in the wind. You do something about it. Typically, with this would apply to committed. This is for the case of FX. This would be committed FX exposures. So a good example here would be an Australian retailer looking to purchase a whole load of inventory from, say, China in US dollars, potentially looking to maybe stock up for the Christmas coming up. Clearly, he's going to sell that in Australian dollars, therefore has a big FX risk. To the extent that they actually put those orders in, they really do need to think about some sort of systematic hedging program to lock in some of those costs. Otherwise, to the extent that the FX rate changes, that on the high street, they're potentially going to become very uncompetitive because they're going to have to pass a lot of those costs on or have a margin compression. So systematic hedging is the number one risk, and the number one type of hedging that we see. Typically, I think every corporate that we speak to has some form of systematic hedging. What we are seeing now is these other two hedgings, the active hedging and very much now some of this dynamic hedging. Active hedging, I sort of think really as being a little bit opportunistic hedging there. And by opportunistic, I don't necessarily mean speculative hedging. I'm not saying you're hedging to try and generate value out of your hedge book, but some opportunistic hedging where you've got a view that rates may change. And I'm sure from an FX point of view, those of you with FX exposures, you've been talked to by your dealers over the last few months talking about option volatilities being very low, and therefore potentially putting on some options today would be very good in terms of covering your hedge ratio, taking that up to much higher levels. The dynamic hedging, the example that I really like is really going back to my Aussie dollar, the retailer example, would be what I've described that they're doing is they're covering this season's exposure, but what they obviously are anticipating is next season they're still going to be in business. So why not put some hedging on today for next season? Now the type and the structure of that hedging will be very different, but you can certainly do some hedging where you maybe do it at a lot lower hedge ratio and use different products, for instance, option type products. But and then when to the extent that those exposures become much more committed and much more firm, you can then use some of that embedded value in those options, which will hopefully make you as competitive next year as you hopefully will be this year. One of the key takeaways that when we're talking to our clients, I always say the number one thing on this screen is the importance of systematic hedging must be that it really does remove the temptation of trying to pick the top and the bottom of the market, because systematically it just cannot be done. There's no way it can be done, even across like FX professionals, interest rate professionals, they just cannot do it. So really it's about risk management. Now we all understand risk management has a cost, and what I'm going to try and sort of take you on the journey of is risk management is very important, but there are ways you can be a bit more clever about it and try and reduce some of that cost associated with those risk management. Obviously, all these risk management solutions really form the backbone of a risk management strategy. So I just want to spend 2 minutes just talking about how at CBA we consider our risk management strategy, and we try and sort of impose that into the way we look at our clients' businesses. We take a three-tier approach. The first one is really identification, really measuring and understanding the risk. The second one is then trying to work out which is the best solution. And the third one is execution. Now, it may sound obvious, I'll go this way this time, but first stage is obviously identifying the exposure. Now, that's a 2-second job, hopefully. It should be very simple to actually identify what that exposure is. To the extent that you have borrowings and they're floating, you've got a risk that rates will go up quicker than you anticipate. The hard bit of this whole thing is this second part here, and it's really understanding the impact of those potential market movements. Going back to my earlier example of the Aussie dollar, the retailer, to the extent that they can pass any FX movements onto all their clients and sell those garments in Australia, given those FX movements, they actually don't have any FX risk at all. But the question is, at what point does it become uncompetitive? So that, I think, is the much harder question to answer. Once you've got a very clear understanding of that, quantifying what that risk is the next stage, and that really allows us to have a very clear understanding of what the risk is and what we're trying to do about it. That then allows us to go into that second pillar, talking about evaluating all those different risk management solutions. And what I'm going to sort of focus on at the end of this presentation is that third part there, really looking at some of the risk and reward. Like I say, risk management is about trying to remove that volatility in terms of costs or earnings, and removing that and minimizing that is clearly the goal. But a secondary goal is trying to reduce the cost of that as well, because there is always, if you do any hedging, there is always a cost. Execution I'm not going to talk too much about. The only thing I'd probably say in terms of execution is it clearly depends on how often you're hitting a particular market. For instance, in foreign exchange, people that have regular exposures will be hitting the market on a much more frequent basis. So the chances of them sort of mirroring the average rate for the year, which potentially could be their budget rate, is a lot easier than say, people going in once or twice a year with some very big exposures. And seeing as the next chart I'm going to show you is that the Aussie dollar is an extremely volatile currency. The chances of you having very big FX gains and losses in there, and potentially being being very uncompetitive with your peers, is huge. So that's the only thing I'd really want to talk about in terms of execution. Obviously, one of the things you are trying to do from this hedge policy is reduce this volatility. Whether it's in your costs or your earnings, you're just trying to reduce that volatility and have a nice stable cash flow. So what I thought might be useful is in global markets, we really look at foreign exchange, interest rates, and commodities. I thought it might be useful just to have a look at what the sort of historical volatilities have been. There's a general feeling, I think, at the moment that the volatility is low. And I think when we look at the FX volatility there for Aussie US dollar rates, you can see that actually we are pretty close to those historical lows. What we saw obviously during the global financial crisis there is volatilities went up to very high levels, 30%, but did actually come back quite quickly. And we're seeing sort of in the most recent months, we are seeing back to those sort of pre-GFC levels. Looking at interest rates. Interest rate volatility has typically been lower, sort of pre-GFC. We're sort of seeing, I think, that coming back. But in terms of the actual levels of where those volatilities are, we're seeing them basically come off and back to sort of similar levels. However, when we look at commodities, it's generally we see that commodity volatility is significantly higher than any other, than certainly FX markets and in interest rate markets, and so clearly that has very big implications for producers of iron ore, coal, etc., and where they are on that cost curve as to how they go about hedging. Typically, these guys don't hedge their underlying commodity, but try and hedge all the other parts of their business. But I would say that potentially that's changing as we go forward. The other comment I do want to make here, which is more about an Australian. So your job as an Australian treasurer is significantly more harder than say someone sitting in the US or Europe. One of the reasons being that the Aussie dollar volatility is the highest volatility out of the highest traded currencies. So therefore, that just makes your job a lot more complicated, and you're doing a lot more work to effectively get the same outcome. That's not that relevant, so we'll skip it. So, like I say, in terms of this risk management framework really comes down to this hedge policy. These are some of the key things that we always talk to our clients about. What to hedge. Typically, that's not a decision that is made within the finance. I know there are certainly situations that we've helped clients with in terms of putting up to the board policies as to changing hedge policies or changing what people hedge. But typically, that is made by the board or the key stakeholders. Obviously, down at the smaller end of town, when you're looking at the business and private banks, the SMEs, that they can decide what they change their hedging decisions more frequently. So really we have to focus on, given that we have this framework, how do we actually go about hedging what we're basically told to hedge. The number one thing which we always say is obviously only hedge the net position. That should be obvious. And the final thing about in terms of what to hedge, always look out for these natural offsets. So to the extent that you've got a single exposure, whether it be foreign exchange or interest rates, you don't need to worry about that. To the extent you have more than one exposure, there may well be a natural offset, whereas, for instance, an iron ore producer here, which iron ore typically has very high correlations to the Aussie dollar. To the extent that the iron ore price goes up, the Aussie dollar price goes up, which acts as a dampening effect. But conversely, when the iron ore price goes down, the Aussie dollar price goes down, which again dampens that as well. So by hedging one of those and leaving the other one floating, you actually could potentially be introducing a lot more risk into the business, and that's just something to be very, very cognizant about. But clearly, hedging is not there to introduce more risk into the business, it's there to de-risk. Next sort of thing that we touch on is how much to hedge. Clearly, this comes down to the certainty of the exposures. We deal with a lot of clients, for instance, a lot of construction companies that need to tender for bids and potentially looking to have equipment in different currencies. Obviously, when they tender for the bid has to be firm. So how do they go about hedging that, seeing as they may or may not be successful in the bid? It's a very good sort of case study. And clearly, how much to hedge, the impact on the business. If you can survive the big movement, the big swings, positive or negative, in terms of the exposure, then I would suggest don't hedge. But not many businesses can survive those big swings in the exposure. Therefore, that really says where your pain point is really is is really how much to hedge. So I think, and finally, it comes down to a hedge budget as well. What I'll show you on one of the last slides is certainly when you have a look at, in terms of foreign exchange hedging, hedging using something like a forward exchange contract from an accounting point of view typically has a known cost up front, whereas using an alternative strategy can actually maybe mitigate some of the costs of that. But obviously you still want to make sure that if things don't go your way, your hedge budget is your worst case scenario. How long to hedge for? This is obviously not so much of an issue for committed exposures. Committed exposures, you just have to hedge the committed exposure. But obviously, it's very relevant for interest rate hedging to the extent that you're trying to find potentially a sweet spot in the yield curve to hedge out for. One of the conversations that we mostly have is how to hedge. A lot of clients think it's either hedge or not hedge. That's the decision. It's clearly much more complicated than that. We like to split our hedging products into three main sections, and in the world of FX, that would be absolute limiting range products. So that would be so things like an FX forward or in interest rate world just a swap. At the other end of the spectrum is products where you have unlimited participation. You can think of these things as more like insurance contracts. So, for instance, board options, where you have a known worst case, but to the extent rates move in your favour, you have unlimited participation. And then somewhere in the middle of that sort of continuum is these limited participation structures, and for that, things like collars or corridors or any of those other structures that I'm sure at some point you've experienced. And finally, obviously, a very important part of determining how and what to hedge are the accounting implications. The general accounting is critical. How actually those exposures are booked by your accountants. And obviously, hedge accounting plays a major role. And with the introduction of IFRS 9 coming in, it certainly makes some of those alternative strategies a lot easier to account for. And the other thing I would sort of put in with this accounting implications is some of the concepts my colleagues have been talking about in terms of the regulatory implications as well, and in terms of OTC clearing and CCPs. So what I want to sort of round this session off is to give you a couple of ideas of some of the tools that we use with our clients in terms of trying to help them determine what the most appropriate product is or what the most appropriate strategy is for their hedging. So here's the first way, and they're both foreign exchange examples. Apologies to those of you who are hoping to hear some riveting thoughts on interest rates from me. So the first one is a historical analysis. So we obviously have quite a lot of historical data that we have access to, and we can go back and say, well, how did this strategy perform compared to this strategy? So the benchmark strategy for any sort of foreign exchange, I think, is the FX forward, the forward exchange contract. And what we basically did is we went back as far back as we could get data. In this case, it's all the way to 2000. And we actually put on, in this case, it was a 6-month forward exchange contract, and had a look at maturity, whether that was a good thing to do in terms of it actually generated some value, or if it was a detrimental thing to do. It was a bad thing to do in terms of actually would have been better not doing it. So this top chart here, I'll go this way, shows to the extent that there's a line above the line, above the x-axis, so that there's a positive return, that would be obviously a good thing. And to the extent that there's a below the line, that means that by locking in that foreign exchange contract, you've actually subjected yourself to that significant opportunity cost. Now that top chart, I think, really shows that you can quite clearly see from there that there's a lot more stuff below the line than there is above, but to the extent it is above, it performs quite well. So what I've tried to do in that lower chart is summarise that in a histogram, and what we can see there is the maroon area is significantly larger than the blue area, and the actual data there is the maroon area is approximately 70% of the time. So 7 out of 10 times putting that particular contract on would have been economically not a great idea, whereas 3 out of 10 times it would have been a good idea. And when we look at sort of multiplying that in terms of an average cost, we get a cost of hedging here of being around about 3.8%. Now remember what I said. Firstly, systematic hedging is critical importance because it reduces that variability. So I'm not saying don't hedge, I'm just saying this is the implied cost that you have in terms of using that as a hedge strategy. Is there an alternative? I think it would be very strange if it wasn't. So going to the other end of the spectrum, like I say, I'm going to sort of skip all the bits in the middle. So from forward exchange contracts on one side, absolute sort of optionality on the other with the at the money, in this case Aussie dollar put option. What you can see here is the chart on the upside and the positive side is very similar. So blue is the returns from the put options, and the grey is the returns from the FEC. You can see on the upside here very similar results, whereas the main difference here is really that access to that opportunity cost. So you can see here that by putting on this put option, actually the number of times it was right, it was a good thing to do, goes down, but in terms of the average cost, that's actually reduced by about a third, including the cost of the premium. So it's a reasonably compelling argument, and really what's happening is that all of this tail risk here is being sort of taken away from the fact that you've picked a product which allows you to participate. Just a final 2 slides. So, on one side here, yes, systematic hedging is critically important, but it does appear to be, certainly in foreign exchange terms, a reasonably expensive procedure. Now we've got forward exchange contracts on one side that look fantastic. They're basically free, but they actually have an enormous implied cost. And on the other side, we've got these options that we have to pay money out front, and that's a very difficult conversation to have with the board, but they do seem to perform very well. So is there some other way of sort of maybe of using some combination of them at certain times? Maybe it'd be better to go over here, and certain times it's better to be over here. Well, one way of doing this, and there are many ways of doing it, but one way that I thought might be good to sort of illustrate would be just to have a look at the historical, I guess, the historical performance of Aussie dollar over history. So here we have all the way, so we've seen the lowest Aussie's been since 2000 has been 48 cents, and the highest it's been is 112. If we were to sort of chart that in terms of a cumulative chart, what we're interested in, of course, is to the extent that we're down here, then that's very from the point of the importer, the retailer, who is basically selling Aussie dollars. very unfavourable rates down here at the 40s, 50s, 60s. Much more optionality is really needed because there is much more opportunity cost. If you believe in mean reverting models, then sort of going back to that mean means you've got a lot more opportunity cost. So that would certainly imply a much more heavier use of things like FX options or those alternative strategies. To the extent we're up here in the ones and the just over parity, then clearly less optionality is needed. There's much less opportunity cost if you believe mean reversion, and therefore using some sort of FX forwards. And this blue line here is basically goes from 0 to 100. So can we maybe just sort of historically test that by saying, why don't we use that blue line as being the proportion of which we actually hedge forwards to options? And how does that work? The results are here, okay? So the yellow line here is the FX forward. So this is from an accounting point of view. So this is to the extent exposure hits your balance sheet, you book it at spot. Therefore, by hedging with a forward, it will instantly be an FX loss, but it's a known FX loss at that point. That's why the yellow lines are all below, the yellow bars are all below the lines. Of course, the grey line there being the option, it shows some fantastic outperformance in sort of 2007, 2009, 2010, 2011. But to the extent that there is a period like 2013, we actually have this enormous cost here. This is where our option is basically, we're just paying over and over and over, where there's too much optionality there. When we look at this dynamic strategy, I think you can see there, yes, we've got nice periods of outperformance, but this underperformance just doesn't appear to the same level. So this is just a way, I think, and I'm not necessarily suggesting that you all go out there and suddenly change your hedge policies to do this, but it's just a way that you can actually be a little bit smarter about being systematic in your, so you've still got maximum cover of risk, but your costs should over time be reduced. This is sort of one technique we use. I'll just briefly talk about the second technique, which is one of the problems with that sort of historical analysis, is so many things flying all over the place. So you've got spot changing, you've got forward points changing, which is your cost of carry, you've got option pricing changing, you've got all stuff going on. And it's the same in FX, it's the same in rates, it's the same in commodities. Today, the decision that you will have to make to hedge will be based on information that you absolutely know today. Any dealer will tell you, if you want to lock in something for a year, that's the cost. Whether you want optionality or not, they can still tell you the cost. What you don't know, of course, is where the rate's going to go or where the FX rate's going to go. We use a lot of these simulation models to sort of use history in a sort of very mathematical way to sort of project out where rates could potentially go. So here we have in blue, again, apologies, this is FX focused again. In blue, it's the historical performance of Aussie US rates up until the end of 2013. And what we can then do is use our simulation model to simulate out 10,000, 20,000, however many paths we want, and say where is that space that Aussie could potentially be in the period that I'm really interested in. Now, rather than just draw 10,000 squiggly lines and it just looked like a mess that someone's daughter has just drawn, I thought I'd sort of give you these charts here, which sort of show you the key confidence level. So for any of you familiar with concepts such as value at risk, the top line there is the classic value at risk on Aussie going up, and the bottom line is the classic value at risk. What it means is it's the 95th percentile, so it means that only 1 in 20 of those simulations are above, and 19 out of 20 times it's below. So taking that sort of framework, the grey line here, which is the 50th percentile, is half of the simulations are above and half are below. So it's like, if you think about it, it's the expectation of where that's going to go. So if we then apply those simulations to our exposure, and in this case I have an exposure of, I think it was $10 million US exposure in 6 months' time, just to be consistent, then we can actually come up with this histogram of what my Aussie dollar costs are going to be for that exposure. And you can see if things go brilliantly for me, I'm going to only pay $8 million. If things go really bad, I'm going to end up paying $15 million. That's almost double. So again, I think that really shows the variability and the volatility that Aussie FX rates have historically had and continue to have. So that's, I know as an Aussie dollar importer that I can only sustain for the sake of argument, say $12 million. So I can put a structure in place that looks like a strange horn-type structure, which is a FX collar. What this does is it sort of allows me to participate all the way down to somewhere in the region of $10.5 million, which is, I'm okay with that. But to the extent that the rates do go unfavorably, I know my worst case scenario is around $11.5 million. So I can use this sort of technique not just to structure my FX structure, but in terms of it tells me that the chance of me being hit on the top side, i.e. me giving up that protection, is much higher than the lower side. So therefore, this is actually a very good structure for me as in terms of a purchaser of this particular structure. Key themes. I just want to spend 2 seconds. Key themes. Systematic hedging is critical importance. It's very good at reducing that risk, which is obviously of maximum benefit, but there is a cost associated with it. Blind systematic hedging will achieve that, but it comes at a cost. And I think there are many other ways where you can actually reduce some of that cost and just use some sort of smart, use some science in terms of allowing you to reduce that cost and look fantastic to the board.